Okay, good evening and welcome back to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we have a very special topic for those of you that trade options, and that's how to generate income in your portfolios using options. Now, this webinar is really for those of you that are investors in stocks, and I think that predominantly spans most of you, and many of you that are relatively new to options. This is a strategy that we can deploy in pretty much every single equity portfolio. So if you invest in any types of stocks or ETFs, this webinar is to teach you how to utilize options to enhance that stock portfolio or that equity portfolio to generate higher amounts of yield in your portfolio. And especially in this lower interest rate environment and negative yielding rates, everyone is seeking income, and options is not typically where you look for income. However, this is one of the major use cases of how to utilize options to generate income on your existing stock portfolio. And actually, in my opinion, one of my favorite things about this particular topic is that most option strategies that we talk about involves adding risk to your portfolio because you are speculating on the directional move, and in order to speculate on that directional move, you need to take risk. But when we're talking about enhancing your equity positions or your equity portfolio, we're actually removing risk from your portfolio. So that's one of the great things about the topic that I'm here to talk about, is that while we're going to be talking about how to generate income for your portfolio, how to reduce the cost basis of the stocks that you own, all the strategies we're going to talk about here today involve taking on less risk than your current equity portfolio. And the best part is that if you currently invest in stocks, you are effectively using two transactions. You're using a transaction to buy that stock, and you're using a transaction to sell that stock eventually at a higher price. So what we want to do is we want to show you how you can utilize options to replace two of those strategies. So let's go ahead and get started here. Before I do, just a quick disclaimer. What I'm going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, I just want to say I believe everyone here already has access to an Options Play account, but if you do not have access, or if you're a first-time viewer of our education, I just want to reiterate, you can sign up for a free access to all the tools that I'll show you here today at optionsplay.se. This is courtesy of the NASDAQ exchange. Not only do you get access to the tools free of charge, you also get access to education like the one you are on tonight every couple of weeks. For those of you that were in Stockholm or at our event on Tuesday, events like that are all free of charge to you when you register for a free account here at Options Play. So I highly recommend you to do that. And for those of you that are brand new and in the learning process, we have a full on-demand videos library to help you learn more about options trading. And that library is just growing every single week. We're adding more content so that you have access to the education and the tools to be able to learn more about how to trade options. And lastly, what's going to be most relevant to our topic here today is the weekly cover call and short put reports. These go out every single Monday, and they are optimized reports for what I'm going to teach you here today. And that's really selling cash secured puts to help you acquire your stocks at a lower price, and then eventually sell those stocks, hopefully at a profit in the future at a higher price. And you can use cash secured puts to buy your stocks and cover calls to sell your stocks, hopefully at a profit in the future. So those are all the things that you get access to. So please register for a free account at optionsplay.se to access all of it. Now, and I just want to announce again, this is something we did talk about last time, but I just want to make sure everyone knows, for those of you that are new, that we just launched the both English and Swedish version of Options Play. There is a little flag here on the upper right-hand corner of your Options Play account where you can switch languages. So currently, as you can see, it's got a US flag, which means it's English. If you click on that flag, you'll see a drop down for both US and Swedish, so that you can utilize this tool in the language that you're most comfortable in. So that's a great announcement that we've recently just launched, and I hope that you guys are able to take advantage of that. Now, before I jump in, I just want to make sure everyone can hear me loud and clear, and everyone has the chat window. If you can bring up your chat window, which is at the bottom of your screen, and just please type yes if you can hear me loud and clear. I just want to make sure everyone here can hear me before I continue going on. Okay, perfect. I see a lot of yeses. Perfect. And I see a lot of you are on already. So I do want to have one poll before we get started. I just want to get a sense for what is your current options trading experience? So please answer the poll that's on your screen. You know, are you new to options trading? Do you have some experience? I just want to get a sense for the audience here in the room. Okay, so I see so far, this is close to or actually there seems to be far more of you that are in the process of learning and have no knowledge of options trading, and about a little over 30% of you either have some experience or is currently trading options. So yes, great, perfect. Sounds like Nicholas cannot hear us here. Nicholas, you might have to restart yours. Well, you probably can't hear me. So look at this, 50% of you are in the process of learning how to trade options. So for those of you that are learning, welcome. I really hope that this inspires you to take a look at options, and I hope that our education is helping you learn more about this. And not only are we here to provide you with the education, more importantly, we're here to provide you with the tools that allow you to actually implement your education once you finish. And that's what I'm hoping to achieve here today, is so that everyone walks away and is able to see how to utilize these strategies, but more importantly, know how to utilize options play to implement them. So a few things that we're going to go over here today. I want to go through the PowerPoint stuff relatively quickly so that I can show you as much of it on the platform as possible. But since many of you are learning, I think it's really important to go through the concepts as to why we use certain cover calls and cash secured puts to help you generate income, and what are the best practices, because there are many ways that you can do this, and we tend to find that there are ways that are better than others, and we want to make sure that you understand why that is the case. So we'll talk about a few different things, but number one, we'll talk about what are the top 2 income strategies, why your equity portfolio provides the opportunities for you to generate yield. Because if you don't have an equities portfolio, if you don't invest in stocks, then this is not a strategy that you can implement. So it's important to know why your stock portfolio provides you with the opportunity to generate income. Then we'll talk a little bit about how to actually, or what are the optimal income strategies, meaning how do you select the correct expiration date and strike price for your portfolio, and then showing you how to automate a lot of that using options play, because that's really where you're going to be able to take advantage of everything that we're going to show you here today. So let's go ahead and get started here. So most income related educational content with respect to options, most of it starts with cover calls. And if any of you that have ever traded options, you're probably familiar with a strategy called cover call. However, a cover call assumes that you already own the stock. And as you know, every portfolio starts with cash, and you need to take that cash and acquire some shares or stock with that cash. So that's why I like to start my conversations talking about a short put, because a short put is a strategy that allows you to acquire your shares at a lower price or at a discount. So the goal here is to help you start enhancing your portfolio by purchasing the stocks that you want to purchase with a discount. And the way to do that is by selling a put. And how you can do that is you can sell a put at the purchase price that you want to acquire a stock at. So we're going to go through a few examples, but first I want to explain the strategy. Now, what does selling a put mean? Selling a put simply obligates you to buy the stock at the strike price upon the expiration date. So Now, for those of you that are equity investors, you might be more familiar with the strategy of buying a stock using a limit order or a market order. And that's exactly what a limit order or market order obligates you to do, is buy the stock at a certain price. So a short put provides you with the same obligation, and you can choose the strike price, meaning what price you want to buy the stock at, and an expiration date, meaning by what time do you want to buy the stock at. And for each put that you sell, this will deliver 100 shares of stock at the strike price upon your expiration date. And in order to do so, in order to sell a put, what you need to do is you need to put up either cash or margin to sell those puts, because you need cash to actually buy those shares. Just like when you place a limit order or a market order, you need to have enough cash in your account to actually purchase those shares. Same thing when you sell a put. You need to put aside cash to buy the put. But the one thing about selling a put that's different from a limit order or a market order is that when you sell a put, you get paid some income, meaning the cash that you need to put up to sell that put will pay you some income on that. And that income will allow you to acquire your shares at a discount. And usually that discount is about 1% per expiration cycle. So I was saying that for a put option, you have an expiration date. So let's say you have an expiration date 1 month from today, meaning you want to buy the stock at a specific price sometime between now and that date 1 month from today. When you sell that put, you might collect roughly about 1% of the underlying stock price by selling the put option instead of placing a limit order that pays nothing. So the amount that you receive on that put option goes towards paying for that stock. And this is really what a short put is, in essence. So what are the outcomes, right? If you sell a put at a specific price, at an expiration date, what happens? There are two possible outcomes. Either the stock is below the strike price or it's above the strike price at expiration. So just for a simple, let's say example, let's say you have $100 stock. Apologies for the poor handwriting here, but let's say you have $100 stock, and let's say you want to buy the stock at $95, a little bit below the current price, right? So you want to buy the stock at $95. So what can you do? You can sell that $95 put that, let's say, expires in 1 month. And what happens? The stock can do two things. It can either shoot up or stay above 95. That's one possibility. The second possibility is it goes below 95, right? So as a limit order, you are aware that if it stays above 95, you don't own the stock. If it goes below 95, now you own the stock at 95. So when you sell a put, it's very similar outcomes to those two. Basically, the stock can either stay above your strike price. If that's the case, what happens is you keep the income that you receive from selling that $95 put, and you can choose to do that again, or what we call rinse and repeat, for additional income if you still want to own the stock. So you can ask yourself 1 month from today, do I still want to buy the stock? Maybe you want to buy it at a different price. You can change your strike price. Maybe you want to, maybe the stock has moved higher and now you want to move to a higher strike price. Maybe the stock moved lower and you want to move to a lower strike price, or you just want to stay at the same strike price. It's up to you. You can make that decision as to whether or not you still want to acquire those shares and sell another put. The second is that the stock does decline below 95 at the expiration date. And now what happens is you own the stock at the strike price, which is the stock price that you wanted to buy at, which is $95, minus the premium that you receive. So when you sell that put, you collect some income. Let's say you collect $1 for this. So now instead of owning the stock at $95 like you do with a limit order, now you own the stock at $94 because you collected a $1 income, okay? Now, this is very theoretical yet. This is still somewhat theoretical. I want to go through some concrete examples with you guys, but I just want to make sure everyone understands, from a high level perspective, a short put. If you understand that, please type 1 into the chat window before I move on to the next slide. So if everything here on this slide made sense to you, please type 1. Perfect. Okay, I see a lot of 1s. Great. So let's go ahead and move on. Now that you own this stock, Now you can consider selling a cover call. This is the second strategy. Many of you may have heard of this strategy, or maybe some of you have maybe even traded this strategy, but this is the most popular income strategy, or I'm sorry, this is the most popular option strategy altogether. So if you look at all the strategies that are traded in terms of volume, cover calls is the single most popular strategy. And what does a cover call actually do? A cover call allows you to exit your stock at a higher price than the current price of the stock. And what does that remind you of? Exiting the stock at a higher price than the current price of the stock. So let's say you have a $100 stock, you own this stock, and you believe that this stock is going to move higher. And what you want to do is you want to say that at some point, when it reaches a certain point, I want to be able to take profit. I want to get out of this trade at a higher price. You know, in my opinion, that reminds me of a limit order, right? Because you could place a limit order at a higher price. Let's say you place a limit order at 110 maybe. And then what you can do is you can wait for the stock, and the stock can either rise, you know, slowly or fast or whatever it is. But once it reaches 110, you exit the stock at 110. So that is what you would typically use as an equity investor. But as an options investor, what can you do? You can sell a cover call at this 110 price. And what does that do? When you sell a cover call at the target price that you have on an existing stock position, what it does is it obligates you to sell your stock at the strike price upon expiration. So just like a limit order that obligates you to sell your stock at a higher price, in this particular case, instead of a limit price, you have a strike price. And this has an expiration date, which means that this order is good till a certain date, kind of like a limit order that has an expiration date on it. Now, there is one difference, is the fact that when you place a cover call, you do need to sell in 100 share blocks. So let's say you have 300 shares. You can choose to sell one cover call, which would sell 100 shares, 2 cover calls, or 3 cover calls. But let's say you have 350 shares. You cannot sell 4 cover calls. You can actually only sell 3, up to 300 shares, because you can only trade in 100 share blocks when you're trading an option, because options reflect 100 shares per contract. And what this really does is it allows you to take profit on your stock when they rally significantly. Now, I have an asterisk sign up here for this last part, is because this statement is only true if you follow the strategy that we'll show you here in a second as to how to go about selecting your expiration date and your strike price. Because with this, you have to select a strike price and you have to select a specific date as to when that order is good till. And those two things are the things that you have to select when you're selling a cover call: an expiration date and a strike price. So what we want to do is we want to talk about how do you actually select the appropriate strike price. Now, in both of those examples, there's 2 things that can happen, right? The stock can either go above 110 or it can stay below 110 by the expiration date. So you have an expiration date and the stock can either be above 110 or below 110 by that expiration date. And the goal here is to see, sorry, not the goal, but out of those 2 possible outcomes, if the stock goes above your strike price by expiration, what happens is you sell your stock at the target price that you actually wanted to, at the strike price, and you receive some income for that. Because when you sell this cover call, not only do you obligate yourself to sell the stock at 110, but you get paid some income to do so. Unlike a limit order where it just sits there and you don't get paid anything, when you sell a cover call, every single expiration, you're going to get paid some income. And you're going to see that income comes out to be quite a bit. Many times it can be 2, 3, 4 times what you're currently owning or earning on the dividend payment of that underlying stock for owning it. So that's really where cover calls become an attractive way to help you exit your stocks when they do rally significantly. But while you wait for that to happen, you get paid an income stream while that happens. And the second scenario is the stock doesn't rise above 110 and it stays below 110 at the expiration date. So what happens now is you can rinse and repeat again. So you can basically, once that order expires, you can put in another order to sell at 110. Maybe you want to move it up a little higher because the stock's moved higher, or you want to move it down a little. You can choose new strike prices at that time and choose whether or not you want to sell another cover call. But the goal is to really consistently sell cover calls throughout throughout the lifetime of owning that stock so that you generate an income stream from owning that stock and while waiting for that stock to rally so that you can take profit on that. So if that makes sense to you, please type 2 into the chat window. I just want to make sure that everyone understands this strategy from a conceptual perspective before we jump into the numbers. Okay, looks like I got a bunch of number 2s, and I see Nicholas can hear me now, which is perfect. Okay, great. So now let's take a look at an example here. And I think this is very similar to what I just walked you through, but hopefully this helps illustrate a little. So let's say we have a current stock that's trading at 100 crowns. 100 crown stock, you want to buy it. Let's say you want to buy 100 shares of this stock at a slightly lower price, let's say 95 crowns, and you have a target price of 110, right? So 100 crown stock, you think it's gonna dip a little, and then you believe it's going to move higher, right? So 100 crown stock, you believe that this stock is going to move a little bit lower, maybe to 95, and then you believe it's going to move higher in the long run, right? So let's just illustrate this for you real quick. 95, 110 up here. So the goal is to buy it at a lower price, here around 95. And then you want to sell it hopefully later at a higher price, let's say at 110. So just like we talked about before, you can place a limit order to buy the stock at 95 crowns, and then, or you can sell a put option at the same 95 strike price, but receive 2 crowns to do so. So a limit order doesn't pay you anything, and you have to put aside 95 crowns a share in order to place that limit order. When you sell a put option, because you collect 2 crowns per share on that put option, you only have to put 93 crowns a share in order to sell that put option, which obligates you to the same thing, which is buying the stock at 95 if the stock goes below 95 by the expiration date. Now, this is the first step of when we say enhancing your equity positions, this is the first step because you are now buying your stock at a lower price and you're reducing your risk on the trade because instead of risking 95 crowns a share, now your total risk on the stock is only 93 crowns a share. So you're reducing your risk, and what happens is you're increasing your potential reward because in the original example, if you buy the stock at 95 and it rallies up to 110, your potential reward on this trade is 15 crowns. Your potential reward is 15 crowns per share. But if you were able to reduce your cost basis from 95 down to 93, what you get is now a potential reward of 17 crowns a share. So not only have you reduced your risk, you've increased your potential reward. And again, that's the first step in improving the risk to reward ratio of every single stock trade that you make. And in both scenarios, you have no exposure in stock XYZ until the stock declines to $95. But in the cash secured put, even if the stock doesn't decline to $95, you'll collect 2 crowns every roughly month or so that you're willing to buy the stock. So if, let's say, by the expiration date, the stock does not decline to $95, what you can do is you can sell another 95 crown, another put at 95 crowns and collect another $2. So even though you never hit your limit order, in the limit order side, you get paid nothing. On the cash secured put side, you get paid income every single time it doesn't hit your order price. So if the stock never declines to the price that you want, at least you have an income stream on the cash that you're trying to buy the stock with that you wouldn't have received if you had placed a limit order. And the goal here is to acquire your shares for at least two crowns a share cheaper, okay? So again, I think this is just a better example of what I showed you here in the first couple of slides. And I just want to make sure everyone understands these numbers before I move on. If this makes sense to you, if these numbers make sense, please type 3 into the chat window. Okay, perfect. I see a bunch of 3s. Great. Okay, so let's move on. Now that we own this stock at 95 crowns and we believe it's going to move higher, what can we do? That's really where the next the cover calls come into play, right? So now I own 100 shares at 95 or 93 crowns, depending on whether I used a limit order or a cash secured put. Now I believe this stock is going to rally, right? So let's say it's trading at, let's say 95 right now. And now I think that this stock is going to rally up to that 110 level, right? Now, what can I do? As a equity investor, I would place a limit order at 110, and I would sit there and I would wait, right? And that can happen in the next month. That can happen the next I don't know, year. That process, as far as that rally, that 15 crown rally, that could take a day, a month, a year. You never know. And with a limit order, you're just sitting there hoping that this stock rallies to a higher price. And your potential risk on this, 95 crowns a share, and your potential reward, 15 crowns a share, remains exactly the same. Meaning, if it takes a month, a year, 2 years to happen, your risk to reward stays exactly the same. But when you're an options investor, you can sell the same 110 cover call at the same price that you would place a limit order at, but receive, let's say, 1 crown in income for the next month. And what this does is it reduces your potential risk even further. So before, by selling the cash secured put, I reduced my risk from 95 crowns a share to 93 crowns a share by taking in 2 crowns from selling that put. But let's say I collect another 1 crown by selling a covered call. Now I've reduced my risk down to $92 a share, and I've increased my potential reward up to 18 crowns a share because I'm furthering reduced my cost basis so that if the stock does rally up to 110, the same scenario that I have in the limit order, not only do I risk less money, I actually make more money in the long run. And in this particular case, I maintain exposure in stock XYZ until it rises up to 110. But in the cover call example, I can generate an income stream until it rises up to 110. While here on this side, I'm just waiting. I get paid nothing to wait. Here on this other side, is if it let's say the stock goes up to hold on. Let's say the stock goes up to 100. In one expiration cycle, goes back down to 98, goes up to 107, goes back down to 102, goes back up to 109, goes down a little, and then it finally goes up above 110. And let's say that's 1, 2, 3, 4, 5, 6, 7 expiration cycles. And let's say I collected 1 crown each time. What I'm doing is I'm furthering reducing my risk by 7 crowns over these 7 months that I'm waiting for this stock to rally. What that means is I'm reducing my risk from 93 crowns from selling the cash secured put down another 7 crowns to, let's say, 86 crowns. So I've reduced my risk to 86, which means that I've increased my potential reward to 24 crowns, right? So this is how you can further increase or enhance what I call enhancing your equity position by using these types of option strategies. And again, these option strategies are reducing risk in your portfolio. They're not adding any additional risk. And that's really the beauty of these 2 strategies. And these are the only 2 option strategies that do not add more risk to your portfolio. They actually remove risk from your portfolio. And the goal here is to get a lower break-even price on the stock that you own and receive at least 3 crowns in a share in income that you wouldn't have received if you simply placed the limit order. Now, if this all makes sense to you, please type 4 into the chat window. I just want to make sure everyone understands the math behind this before we move on. Okay, perfect. I see a lot of 4s. Great. Okay, let's go ahead and move on. Now that we've talked about the strategy, now that we've talked, giving you an example so that you understand kind of from a conceptual perspective how this works, let's jump into how do you actually select expiration dates and strike prices. And I want to do this because many times, if you're learning how to trade options, what we tend to find is that many times you're looking at pages that look like this, right? There are a lot of different possibilities when you're looking at an option chain. You have every single expiration date and strike price, and there's a lot of different choices, right? You can choose from December, January, February, and there's lots of strike prices. There's anywhere from 170 all the way up to 235. So when you're selling a put, how do you choose what expiration date, what strike price? When you're selling a call, how do you do the same thing? This is the most, I think, confusing part for users once they learn the concept, right? Because you understand the concept, and I just talked to you about, a stock that's trading at 100 crowns. But when you're looking at a stock that's trading at 300 crowns or 340 crowns or 322 crowns, how do you decide what is the right strike price to sell for your put? And what is the right strike price to sell for that same cover call? So that's what we want to talk about. So number one, whenever, we first have to select an expiration date. So I want to talk to you through the expiration dates first. And just like when you look at a page that looks like this, you can choose what I would consider short-term cover calls. So like a December 20th, which expires in just 7 days. That would be really, really short. But let's look at January. That's about 1 month from now. That would be, I would say, a short-term option. If we look at February, in this particular case, this stock only goes out to February. That might be more medium term. And then if we go out, let me see if I can find a stock that has further. Let's look at H&M that has more strikes that are listed. If we look at H&M, you'll see listings from December out to January, out to February, out to March, out to June. June would be what I would consider long-term. March would probably be something more medium-term. And then January, February are more short-term, okay? So what you have is you can choose from short, medium, or long-term options. Now, what happens when you choose these types of options? Number one, when you use a short-dated option, we have what we call more certainty, because when I choose an option that expires in December or January, I have a fair amount of understanding as to what's going to happen between now and then. Meaning, I generally know if there's going to be an earnings announcement in that time frame. I generally may have a better understanding as to if there's a dividend going to be paid, if there are any new product launches or big events for that particular stock that I should be familiar with. Versus if I sell a long-dated option, let's say I sell a June 2020 option, I have a lot less certainty as to what's going to happen. So what you see is that the further out in time you go, the less certainty you have, the more income you're going to receive. So the question is, should I choose short, medium, or long-term options? And many times what I tend to see most users do is they gravitate towards the longer term. And the reason for this is because the longer term has more income. But what we wanted to do is we wanted to back test this. We wanted to actually test selling short-dated options, because the difference between selling a short-dated option with less income is that you can do it more often, right? When you sell a long-term option, you certainly get more income, but you can't do it as often. So the question is, what pays you the most money in the long run? And our back testing shows very clearly that it's actually the shorter term option that pays you more money in the long run, because yes, you get less income, but you can do it more frequently. And there's two primary reasons as to why the short-term option pays you more income in the long run. Number one, when you sell short-dated options, you can avoid the earning cycles fairly well, because if you sell 1 month options, you can do that 12 times per year. And we know that there's 4 earnings announcements each year, which means that only 25% of the calls that you sell or puts that you sell have earnings built into it. So you can actually avoid selling those 4 months when earnings are about to come up and still sell the other 8 months of the year. Versus if you sold a 3-month call, you can only do that 4 times a year. It becomes very difficult to avoid selling a call option that has an earnings built into it. And that's why whenever we're selling options in general, we want to lean towards the shorter end of the spectrum, because we can avoid selling going into earnings. But the second reason, and the primary reason why we generally want to sell short-dated options, is because the premium or the income that you receive is not linear to the amount of time that you go out. What do I mean by that? That means that if you sell a 1 month call, let's say you collect 2 crowns for that. When you go to the same option chain and you look for a 3-month call, you can't expect to get paid 6 crowns for that just because you're going out 3 times the amount in time. We tend to find that you only get paid 2 times. So if you get 2 crowns on a 1 month option, let's say you get 2 crowns on a 1 month option, you're not going to get 6 crowns for a 3-month option. You're only generally going to get 4 crowns. What that means is that you can actually sell options in the same amount of time as this, and the net total by selling 1-a-month options 3 times over is that you get 6 crowns here versus only 4 crowns here for the same amount of time. That's why whenever we're selling options, we tend to want to be more shorter term, because we can do it more frequently, and that adds up to actually more income. And actually, we can actually even avoid selling the call going into earnings and still collect the same amount of premium as someone who sold a 3-month call, but takes on additional risk, because this option here has this large uncertainty factor built into it. So you're collecting the same amount of income, but you're taking on more risk to do so. Here, we're collecting the same amount of income, but we're not taking on the risk of losing money on that particular earnings play. So that's why whenever we're selling options, and this applies for other option selling strategies too, but for now, let's just talk about cover calls and cash secured puts. You always want to choose shorter dated options. Now, the one comment that I want to make is that because of in the Nordics, we do tend to find that commissions sometimes are larger. There is a limit as to how short you can go, right? You can't go too short, because many times that if you sell a 2-week or 3-week option, most of the trade or most of the income that you collect is going to be paid in commissions. So we tend to find that for the Nordics, the optimal time frame is actually somewhere in the medium term. So what this means is that whenever you're selecting from an option chain that looks like this, if you're trying to compare, well, should I sell the Januaries or the Februaries, you should always lean towards the shorter end of the spectrum. That doesn't necessarily mean that you have to sell 1-month option. It just means that if, let's say, you're choosing between February and March, you should always choose the February one, because the shorter dated option allows you to sell more frequently, which adds up to more income in the long run. So I just want to make sure everyone understands that. If you could please type 5 into the chat window if that concept makes sense to you before I move on to the next slide. Okay, great. I see a bunch of 5s. So now let's take a look at strike prices, right? So just like this page I was showing you, now that we've selected our expiration date, now within an expiration date, as you can see, there are all of these strike prices that I can choose, anywhere from 155 all the way to 210. So if the current price of H&M is at 191, where should I sell my cash secured put? Should I sell the 190s, 185s, 180s, 175s? And if I own the stock, should I sell the 205s, 210s, 215s, 220s, right? There's a lot of different choices here. So let's talk a little bit about how we should select our strike prices. So let's just use this H&M example, right? So the current stock is at 191. And I can choose to sell different strike prices. I can choose to sell maybe the 185, maybe the 180, maybe the 175, right? So the further lower I go, the further the stock needs to go before I own the stock, right? So think about placing a limit order. The lower the limit order, the lower the chance of you owning the stock, because the stock needs to make a bigger move before you own the stock. So here are the 3 choices: conservative, optimal, or aggressive. The aggressive one is the one that's closest to the current price, so maybe the 185. So this is saying that I want to chase this stock. I want a very aggressive price so that there's a high amount of chance that I own the stock. An optimal one is maybe 180, and a very conservative one is maybe 175, right? So the lower I go, the lower the chance of owning the stock. So what we do is we use delta to choose our strike prices. The delta tells us the probability of us actually owning the stock. So an aggressive one has a 40 delta, meaning about a 40% chance that the stock will be below 185 and I'll own the stock. And the lower I go, the lower the delta, because the lower the probability of me owning the stock. The lower strike prices I choose, the less chance that I own the stock, the higher the chance that that put will simply just expire worthless. So that's what the 80% POW means. So 20 delta means there's a 20% chance of me owning the stock, or basically an 80% chance that I'll keep the income on the put and get to do it all over again. Versus a more aggressive one, I have a 40% chance of owning the stock, so only about a 60% chance that I keep the income from the put and sell another one. So the conservative strikes are lower strikes, right? The stock needs to make a much bigger move before I own the stock, a much bigger dip. In exchange for that, I'm going to get less income. The more aggressive strikes, these are higher strikes, the 185 strikes. These require a smaller dip in the stock before I own the stock, and they generate more income. So the question becomes, where should I sell my strike prices? Should I sell the 185, the 180s, or the 175s? And the answer is, you want to sell the more aggressive strikes. So our research shows that whenever you're selling a cash secured put to own the stock, you want to sell the higher strikes that require a smaller dip and it generates more income. And the reason for this is because when you sell a put, you want to own the stock. That's why you're selling the put in the first place. That's why we always generally want to have a higher probability of acquiring the shares. So in this particular case, I want this 40% chance of owning that stock. And the win-win here is that with a more aggressive strike price, I get higher amounts of income, which translates to a larger discount on the actual purchase of my stock. So that's why whenever we're selling a cash secured put, we generally want to sell cash secured puts of strike prices that are relatively close to the current price of the stock. So on a 191 crown stock, I might want to sell a 185, close to the current price, okay? So if that makes sense to everyone, please type 6 into the chat window. Okay, perfect. So now that we own this stock, right? Let's say we own the stock at 185, and let's say we own the stock at 185. This is H&M, right? Now we want to sell the stock at a higher price in the future, right? So let's say we own this stock and we want to be able to take profit on this. So maybe we might want to sell a 190, a 195, or maybe even a 200 strike price, right? Depending on what your goals are, how far you think the stock can go. The goal here is to see how far can the stock go before you get called away or before you take profit on this particular stock. So let's say we have 190, 195, and then let's say 200, right? So those are, and this is just kind of an example here of what you can do. So the conservative strikes are these really high strikes, meaning the stock needs to make a significant rally before the stock is called away. And that has a 10 delta, meaning about a 10% chance that the stock is going to rally from 185 to 200 by the expiration date. Remember, all of these have expiration dates, meaning they have to make that move within a certain amount of time. Remember, we talked about we generally want to choose short-dated options whenever we're selling options. So you have a relatively short amount of time for this stock to rally 15 crowns. So this might have a very low probability, a 10 delta, or about a 90% chance that the cover call that you sell will simply expire worthless and you keep the income and you sell another cover call, right? The optimal one, the 195s, this has about a 20 delta or about an 80% chance that this call will expire worthless. Or the more aggressive call, the 190 call, is a 30 delta, a fairly high amount of probability the stock will rally a small amount, which gives you a lower probability of profit. So, I'm sorry, the probability of the call expiring worthless. So the more conservative strikes or the higher strikes, this requires your stock to rally significantly more before the stock is called away. It has to rally 15 crowns in this short amount of time. It gives your stock a lot more upside before the stock is sold off. The optimals are somewhere in between, and the aggressive ones require your stock to rally just a little bit before the stock is called away. So the question is, which ones do you generally want to choose when you're selling cover calls? And our research, we did back testing on this strategy as well. And what's interesting about our research is that when we sold the cash secured put, we want to sell puts that are close to the current price. But when we're selling cover calls, we found that you want to sell calls that are further away from the current price. We tend to find that the conservative strikes were better for selling cover calls. And the reason for this is because of one very important thing. And the most important thing to remember that when you're selling a cover call is that you own this stock. Why do you own H&M stock? You own H&M stock because you believe it's going to rally. And you need to be able to take advantage of those rallies when they do happen. And the only way to do that is selecting these conservative strike prices, because what you want to do is you want to prioritize the capital appreciation of your stock, because at the end of the day, you're still taking on 185 crowns of risk every single on every cover call, because this stock can go to zero, right? You're taking on all of this risk that the stock can go down to zero. You need to offset that risk with enough upside so that you are actually able to take advantage of the stock when it rallies. Because if the stock rallies up to 200 crowns and you sold a 190 cover call, you've given up this $10 in upside. If you sold a 190 crown cover call and the stock rallies up to 200, you do not participate on any of that, because you've sold your stock at 190. When you sell a cover call, you obligate yourself to sell the stock at that price. So you want to make sure that you select a strike price that's relatively far away, so it requires a large move in the underlying stock before it gets called away, before you take profit on it. And so it's why when you're selling cover calls, it's very important to select a higher strike price than when you're selling a cash secured put. And I just want to make sure everyone understands that before I move on to the next one. So please type 7 if you understood what I discussed here in this particular trade, in this particular slide, why it's so important to select higher strike prices when you're selling cover calls versus when you're selling cash secured puts. Perfect. So just to reiterate a little bit about what we talked about here. Number one, you want to acquire shares at a discount by selling cash secured puts. That's your first step in enhancing your stock positions. Once you own that stock using a cash secured put, that's when you want to start selling cover calls. And the key here is that you need to start selling cover calls immediately after acquiring the shares. And the reason I say this is because I get a lot of questions from users where maybe they bought a stock at 100 crowns and they didn't start selling cover calls immediately. And what happens is after the stock declines a little, let's say at $80, down to 80 crowns, then people start saying, oh my God, I'm down some money on this trade. How can I make some of that back? And they think about, oh, I remember cover calls. I can generate maybe 1 crown a month in income. So maybe that'll help offset some of my losses. Why don't I start selling cover calls now, collect 1 crown a month, and maybe work my way back? And the answer is, by that time, it's a little too late, because at that time you might be selling, let's say, an 85 or 87 crown cover call. So if the stock rallies a little bit and the stock does get called away, now what's happened is you've locked in a loss, right? So that's why whenever we're selling cover calls, you need to start selling it immediately to really utilize the effects. If you wait until the stock is already down 20, 30%, it's too late, because even if you sold the cover call, you might end up locking in a loss on that particular trade. So selling cover calls on a stock that you're already down 20, 30%, not a good time to start doing that. And then whenever we're selecting these types of options, number one, shorter dated options help you maximize time decay. So shorter dated options allow you to do it more frequently, which adds up to more income in the long run than longer dated options. And whenever we're selling cash secured puts, you want to sell cash secured puts near the current stock price. And when you're selling cover calls, you want to sell cover calls further away from the stock price. And lastly, you want to avoid selling these strategies going into earnings. So if you know when the earnings date is, you generally want to avoid doing that. So with that, what I want to do is I want to jump over to options play. I took a lot of time to explain things today, and I purposely did it a little slower because, more than half of you said that you're new to options, and I didn't want to just run through it without all of you understanding it. And for those of you that have some experience trading, I hope that at the very least that I was able to show you something new as far as why you should use certain criteria for selecting expiration dates and strike prices. So what I want to do now is I want to walk you through how options play is designed to automate what I just showed you here today. Because it's one thing to understand it, it's a whole nother thing to implement it. And we built our tool to make the implementation piece as easy as possible once you understand the education. So on the options play tool, now I'm not going to spend a lot of time going through the tool today, but on the tool itself, you have 2 tabs on the right-hand side. You have trading and you have income. We're going to focus our attention today on income. And before you utilize the income tab, I just want to show everyone the income settings button here at the bottom of your screen. The income settings allow you to create the settings that I just talked about. Short, medium, or long term for your covered calls, and conservative, optimal, or aggressive for your covered calls and your cash secured puts. So remember, we talked about when you're selecting expiration dates, short, medium, or long term, you always want to gravitate towards the shorter end of the spectrum. But again, I tend to find that because commissions are a little higher in the Nordics, that we tend to find that medium-term options are a better suit than most short-term options. I can show you some short-term options during the Q&A session to show you how small the premiums are, sometimes not even enough to account to cover the commissions. So again, when I'm looking at cover calls, I like to do medium-term optimal or medium-term conservative. And for puts, I like to do medium-term aggressive. Those are my settings, right? But you can create your own settings. This is part of what this tool is designed to do. And what you can do is you can type in any symbol, and I have a whole watch list of just all the Swedish derivatives. So if let's say you own Saab stock, right? Let's take a look at Saab. Saab is currently trading at 319 crowns. And what we want to do is we want to show you, let's say you want to own this stock. What can you do? So on the income tab, you have two choices. It'll ask you, do you own shares of Saab? If let's say you don't own these shares and you want to acquire the shares, then you can click on no. And what it does is it selects the expiration date and selects a strike price for you. So here it's selecting February 2020, a 300 strike put. So a 300 strike put is about 20 crowns below the current price of the stock. And as you can see here, this collects 660 crowns in income for every 100 shares. Now, what does that actually mean? If you place a limit order to buy the stock at 300 crowns, you would have to put up 30,000 crowns to place that limit order. When you sell a put option, instead of having to put up 30,000 crowns, you only have to put up 29,340 crowns, which is a savings of 660 crowns. And that's the income that you receive on selling this put option. What does 660 crowns mean? 660 crowns means a 2% discount on your stock in the next 71 days, because there's 71 days until February 21st. So you're going to collect 660 crowns on the $29,000 cash that you have, 29,000 crowns that you have to put aside, which annualizes out to 10% on the cash. So this income comes out to be about a 10% yield on your cash. So think about if you can generate yield on the cash that you're putting aside to buy the stocks at a lower price that you would normally place a limit order for. A limit order doesn't pay you anything. Here you're getting paid 10% on your cash. Those are the types of yields that you can expect from selling a cash secured put. And let's say you now own Saab stock, and now you want to potentially sell the stock at a higher price. So notice the cash secured put was about 20 crowns below the current price. And look at the cover call, same February expiration date, but now it chooses a 350 cover call. So now that's 30 crowns above the current price instead of 20 crowns below the current price. So again, this goes back to when you're selling cash secured puts, you want to select strike prices closer to the current price, and then when you're selling cover calls, further away from the current price. So here, the 350 crown cover call, which obligates you to sell your stock if the stock rallies up to 350, right? So if the stock rallies up to 350 by the February 21st, you will now sell your stock at 350, but you collected an additional 410 crowns in income to place that order. And if the stock doesn't rally up to 350 by the February 21st, you keep your 410 crowns and you can sell another cover call and generate more yield. How much yield is there? 6.62% yield on your stock that pays a 1.42% dividend. So this stock pays an annual dividend of 4.45 crowns. Here, you're getting paid 410 crowns in just 71 days. So you're collecting roughly the same amount of income you would in a whole year by owning Saab in just 71 days. This is the type of yield that you can expect from these types of strategies. So as you can see here, this is almost triple what you're currently getting. I'm sorry, 4 times what you're currently getting from the dividend. The current dividend is 1.4. The yield on the cover call is 6.6. which reflects the 1.2% you're receiving in just 71 days. So I just want to show everyone, does that make sense? Do these numbers make sense to you? If that makes sense, please type 8 into the chat window for SA. And this is just one example, right? The goal of this platform is to allow you to click on any symbol that you own or want to own, so that even if you know nothing about options, that you can take what we taught you here today. You can click on a symbol. Let's say we want to look at, the other day we were looking at Bald B. When I was in Stockholm on Tuesday, when we were doing this event, we were looking at Bald B, which is trading at 408 crowns. And we wanted to look at selling a cash secured put. So here, the February 21st, 390 cash secured put, which is again about 20 crowns below the current price. Here, we're getting 810 crowns on a stock that pays, that does not pay a dividend. So you're getting a 2% discount on the purchase of this particular stock, which annualizes out to about 10% on your cash, because instead of having to put up 39,000 crowns to buy 100 shares of the stock, you only have to put up 38,190 crowns, which reflects an 810 crown discount. And that annualizes to about 10% cash, 10% yield on your cash. And then when you're looking to sell covered calls, now it's telling me to sell a 440 covered call. So about, again, a little over 30 crowns above the current price. This generates 320 crowns in income, which comes out to be about a 4% yield on this particular stock, which this stock doesn't pay any dividends. So you're getting a 4% yield that you wouldn't have received if you did not own, if you own this stock. Because if you own the stock, you would own, the only thing you can wait for is for the stock to appreciate in value. And that's the only thing you're waiting for. Versus here, you can generate yield while you wait for that stock to appreciate in value. And you can use this tool to select any symbol and instantly be able to get a sense for how much yield you can receive, and be able to instantly see the yields on the cash secured put, what expiration date, what strike price is available, and then if you're looking to sell the covered call, same thing, what expiration date, what strike price, and what yields. And once you're ready to execute these trades, you can click on the trade button, which will show you how to enter this trade into your broker's platform. So regardless of where you trade, you have the details on how to go about entering this trade. This is all designed to make this process as easy as possible for you so that you're able to execute these trades very simply here, utilizing options play with your broker's platform. And I just want to show everyone one small thing before I open this up for Q&A. I got a lot of questions regarding how to utilize this platform. I just want to make everyone aware of a few different links that are available to you on your tool. You have a guide button at the very bottom, which allows you to understand what you're currently looking at. It just creates these little help pins that you can move your mouse over, and you can see what each one of the pins actually mean. There's also an FAQ for those of you that are newer to options and you want to learn about call options, put options, the option Greeks, and different things like how the trade ideas are generated, and a lot of the common questions that we get, like what is an options play score? You can find this in our FAQ. And lastly, for those of you that want to learn more, there's a button here at the bottom that says Learn to Trade Options. That takes you to our YouTube channel, which has a lot of the videos that we've been producing, as well as all of the recent webinars that we've hosted, the introduction to options, the platform walkthrough, trading bullish and bearish markets, and soon this webinar will be up there as well so that you can review all of these recordings at your own pace. This is, again, all designed to help you learn more about options. And all of the webinars we teach using options play so that you can not only learn the concepts, but afterwards you can log in and start implementing those immediately. So with that, I just want to thank everyone for taking the time out here this evening. I know I went through a lot of things here today. I don't expect everyone to remember everything that I taught you, which is why we record these and provide you not only with the recordings, but also the slides afterwards so that you can review the slides, watch the recording at your own pace before you start actually implementing these strategies in your portfolio. So I really hope that you guys find this useful for your education, as well as the tools to help you implement them. And at this point, what I'll do is I'll open this up for Q&A. So if you can bring up your chat window, the same one that you typed in all the numbers, just type in any questions you might have regarding what we discussed here today, and I'm happy to answer as many questions as I have time for before I have to sign off here. So thank you so much. I hope you guys have found this useful. Please ask me any questions you have in the chat window. Mats, Jens, thank you so much. I really appreciate it. Paul Eric is asking, how does dividends influence the option prices? Great question. So theoretically, it doesn't influence the option prices directly. What it does is it influences the stock prices directly, and that will effectively influence the option prices. So if there's a dividend that's about to be paid, so let's say in Swedish match, if there's a 10 crown dividend that's about to get paid, what you'll typically see is a reduction in the stock price by 10 crowns or by the amount that the dividend was paid. So if it's at 446, it'll go down to 436. And that 10 crown move will reflect in this price of the call option or the put option that you're selling. But usually, that is already built into the price. So meaning it's not a discrete movement in the underlying stock or dividend, in the option. The option is already pricing in this future downside move, if you will, into that call or put option. So it's already priced into the option. I hope that answered your question. Any other questions regarding cover calls, cash secured puts, or how to utilize the tool itself? If there are no other questions, actually here, Jens is asking, what is the most common risk with a cover call in a bullish trade turning to bearish that needs to be thought of? So Jens, you should, so this is again why I say when you're selling cover calls, you want to sell a far out of the money cover call, because you need to offset the risk of that stock turning lower, right? So that risk that you have is still tied to the stock that you own. So if you own a stock, doesn't matter if you sell cover calls on it, it's not going to protect you if the stock goes to zero, right? It just provides some income on your money so that on your stock, so that if you have a minor downturn, you have some income to show for it. But you still have to decide whether or not, if a stock turns bearish, if you want to own the stock. So let's say you own Swedish Match at 452, right? And let's say as we approach the end of the year, things get really ugly and the stock goes down significantly, right? Cover calls is not going to magically save you from a stock declining sharply. But you have to ask yourself, well, do I still want to own Swedish Match if this stock continues to decline lower and lower, right? If it declines to 370, do you still want to own the stock? Or maybe the stock continues to move lower. Maybe it moves down to this 365 or maybe even lower to 340, right? You have to ask yourself at some point, do I want to get out of the stock? And if you want to get out of the stock, you should sell the stock, get out of your cover call. But that should be a separate decision than the cover call itself. A cover call is simply trying to generate yield on the assets that you own. So if you own Swedish Match, you might as well generate some yield on it, because you're parking a significant portion of your assets to, you've transferred your cash into this stock. If the stock is not appreciating value, if it's not generating the yield that you need, you should get out of that stock and buy another stock that maybe has better opportunities of moving higher. So you have to ask yourself, do I still think Swedish Match is the right investment for me? If it's not the right investment, you would simply sell your stock and buy back your cover call, especially if something turns bearish. So I hope that answered your question, Jens. Any other questions? Hans Shashram, thank you so much. I appreciate it. Nicholas, same thing. Bo, thank you. Bo is asking, how much risk to reward do you recommend on credit spreads? So this is a very advanced strategy. For those of you that are new to options trading, I don't expect you to understand necessarily what I'm saying right now, but the general risk to reward, the golden ratio that we find on credit spreads is 2 to 1, meaning risking $2 for every $1 in income that you receive. So that's the general rule of thumb that we have on credit spreads, Bo. And that's something I will cover on our future webinar that I will do just on credit spreads. I will do a webinar just on credit spreads as well. So that is to come. But that, again, is a more advanced strategy. So that will have to come at a later date after we cover some of the more basic strategies. But if you think about a cash secured put that we talked about here today, that is the essence of a credit spread, is you're really selling a put option and then buying back a lower put to reduce your risk. But you have to first understand a cash secured put before we can understand credit spreads. So this is a learning process. We're progressing as we go. But a cash secured put is a good first step in understanding credit spreads. So Jens is asking a great question. Maybe it's a newbie question, but am I obligated to buy a stock at a certain price if I buy a put? No. So if you buy a put, you have no obligations. So as the buyer of an option, you have 0 obligations. As the buyer of an option, you have the option of selling your stock at that price in the future. So if you, on Swedish Match, if you buy a 430 put, let's say you buy a 430 crown put, what that gives you the opportunity or the ability to is to sell your stock at 430 sometime in the future, or by the expiration date. So what that means is that if the stock is below 400 or 430, you can still sell your stock at 430 even though the value of the stock is well below 430. So great question. Something we'll cover in the next webinar when we talk about the basic of options as well. But when you buy a put, you are not obligated to do anything. You only are obligated to do anything when you sell a call or a put. So the seller has the obligation, the buyer has the option. Bo, I certainly understand why it's tempting to take a higher risk reward, but I have, our back testing shows very clearly that those higher risk rewards do not pay out in the long run. So I don't recommend doing that. Any other questions? Bo, thank you so much. It was really great to meet many of you in Stockholm. We're hoping to do another one of those events coming up in Q2 of next year as well, back in Stockholm. So much to come, but in the meantime, we're going to be doing webinars every other couple of weeks. This is a really great start to a long-term, educational package that NASDAQ has put together for everyone to learn more about options trading, have access to the right tools, and really making sure that you guys have the resources beyond just basic education to actually implement these strategies. So the other thing I do want to show everyone here is that we do publish these cover call and short put reports. So this is something that you actually get an email for every single Monday morning at around noon Central European time. You get this report. This one was updated this Monday for both cover calls and cash secured puts so that you can see for which stocks, which expiration date, what strike price, how much the return actually is provided on that particular stock. We cover all 3 currencies or all 3 markets, Stockholm, Denmark, Finland. But obviously most of the listings are in Stockholm, so that you can see exactly what expiration date, what strike price, and how much yield you're going to get. So just different ways to get to the same information. You can either log on to Options Play, plug it in, and you'll get the real-time pricing. But if you're looking at it Monday morning after your options expire and you're looking to sell another cover call or cash secured put, this report also gives you a very good starting point. You can also use this for security selection. So you can say, well, okay, I can buy Fing Beef with about a 4% discount. That's a pretty big discount. Maybe I want to take a look at potentially buying that stock. Or SAS, I get about another 4% discount on the SAS. And you can see how big of a discount do you get on different stocks and you can take a look at that and decide whether it's suitable for you in terms of buying these particular stocks. So with that, thank you so much. I really hope that you guys found this useful. Like I said, we covered a lot of things here today, so I don't expect everyone to remember everything. So what I'll do is I'll send everyone an email. We'll send everyone an email with the recording and the slides so that you can so that you can review it at your own pace. So thank you so much. I will be back here next Wednesday. So, we just did the event on Tuesday. We did a webinar today. We're going to do another webinar next Wednesday. We're really packing in the educational events in the first few months so that you guys get as much as possible. And then after that, it'll be every 2 weeks. So thank you so much. I hope you guys have a great evening, and I'll see you guys next Wednesday.